Welcome to Indianomics. I'm Lata Venkatesh. Quite a few indicators seem to suggest that the Capex cycle in India has started. Bank loan growth at over 17% is the highest we have seen since 2013, highest in 9 years. Industrial output data, IIP, suggests that capital goods are growing at a strong clip at 16.8% in the April-September period, almost crossing at an index level their pre-COVID levels. CMIE data shows new investment intentions in the first half of this year, April-September, are up 20% to over 8 trillion rupees compared to year-ago levels, over 20%. Capex bellwether company Larsen & Toubro reported a 13% growth in its order book to a record 3.7 trillion rupees when they reported results for the second quarter. The central government's actual Capex spend is 50% higher than it was in the first half of the previous year. This year, first half, it has touched 3.42 trillion. The only lame parameter seems to be state capital expenditure. State government capital expenditure numbers are still subdued at about 1.6 trillion rupees as of end September. Half what the central government has spent. But even this may pick up with the central government giving interest-free loans to the states. So are we at the start of a new Capex cycle, or has the cycle even already started, is the question we are asking. Mr. R. Shankar Raman of Larsen & Toubro, Mridul Sagar, former MPC member and now professor at NCAR, and Mahesh Vyas, the managing director of CMIE, the think tank which has the best data on Capex. Gentlemen, thank you very much indeed for joining me. Mr. Shankar Raman, let me start with you, since you are the man in the trenches, as it were, literally. What's your view? You have seen previous cycles of crazy Capex demand, the like we saw in 2004, 2008. Are you getting a sense that we are at least somewhere near 2003, 2004 with appetite getting whetting?
Definitely, Lata. I think the appetite is improving because I think the factors that are encouraging people to look at Capex are becoming more favorable. I think India has done well through this pandemic and through this geopolitical crisis to steer its own course. It's been able to keep its capital market intact. Of course, the inflation has been a bit of a worry, and then the runaway prices of commodities when the world supply chain got broken caused certain headwinds. But I think it is to the credit of the government that the series of steps that they have taken over a period of time are all sort of beginning to fall in place. I think the effort to improve the confidence of the industry, and the efforts to incentivize production, efforts to localize manufacturing, these are good policy measures. And the fact that the government, central government particularly, is leading the way, and as you rightly said, 50% of the year's expenditure they have already put out in terms of new projects. Since I last spoke to you, I think the state governments have also picked up pace. They are about 30%. Last when I spoke to you, it was more like 20% of that spend. It's now moved to 30% in the month of October and a bit of November. We expect that to gather pace. The private Capex, particularly the manufacturing Capex, have moved ahead further. I think the several areas in which the private sector is beginning to invest. It all started with minerals and metals, where the global prices provided a good tailwind for the sector to increase capacity. But today, with construction activity improving, the construction materials are picking up pace, cement, paint, etc. And also the beneficiary industries, be it in terms of IT industry, data centers, and those kind. And of course, the big mover is the energy. The move towards renewable has also been a large fillip for the private sector.
Got that, sir. That gives us a lot of the nuances, but I'm going to come back with more questions. Mahesh, you have the best data, so tell us what the big numbers are saying. Year on year, the numbers you gave me before the show indicate a growth, but does it look like full-blown growth has arrived?
Well, I won't call it a full-blown growth, but there certainly is is a smattering of good news in many places. So the data does kind of match up to what Mr. Raman was saying earlier. And we have seen a large increase, and I'll call it large increase, in the calendar year 2022, beginning from the quarter of March 22 and then playing on into June and September quarter, in terms of private sector initiatives to propose new capacity formation. So that's a new thing. The slightly not so good news is the government is not matching up to this. So government proposals to create new capacities is very low. Their own Capex is growing quite well, like you said, 50% or so. But that's not going into new projects being announced. So probably they're spending more into announced projects already. But the important thing is that there is a very substantial increase in the number of new proposals being made and the value of new proposals being made, and they're all coming from the private sector. And in the last couple of quarters, we are also seeing a diversification in terms of the business groups that are making these proposals. So it is not limited to the very top end business groups only. In the recent past, it was mostly Ambani and Adani groups and Vedanta and a couple of more groups making the proposals. But now we are seeing a much larger portfolio of manufacturing businesses making new proposals. So that's very heartening.
Okay. No, I take your point. I think just earlier this week, we heard from even the Escorts group that they're going to increase Capex. So clearly the number of groups are increasing. Mridul, over to you now. How is the entire macro picture fitting with, uncertainties on the external sector, uncertainties over rates and inflation? As a macro observer, are you getting the feeling that we are on to higher and higher growth? Is it a robust growth cycle?
Lata, let me put it in correct nuance in the sense that while we are bucking the trend globally, I don't think we are going to see very strong growth, but we will definitely outperform the rest of the world. And from the Capex point of view, clearly we are at the start of an investment cycle. But essentially how the amplitude of the cycle and the duration of the cycle will lot depend on uncertainties which exist. So in a global downturn, some effect can come in India. What we are seeing is a slight effect on business expectations of that. If we see the economic policy uncertainty index, then clearly from the global uncertainty point of view, we are at very high levels now. Okay. So we, much higher than what we had seen at the time of global financial crisis. And whereas in India, those uncertainty indices are pretty low, reasonably well performing. It's below 100 economic policy uncertainty index, okay. Whereas in the time of taper tantrum, it had touched 280. In time of global financial crisis, it was in the vicinity of 250 plus. Okay. So we are definitely better off. But the difficulty is we still have to cross the bridge because investment decisions are not one-off decisions. They are a complex combination of business cycle fluctuations, financial cycle changes, economic, political, and policy uncertainty. Where are the user costs of capital? So both interest rates and taxes also impact investment. So we have to wait and watch how that figures out, translates into actual cap.
Just a quick one. What is the uncertainty index? Who puts it out? That's interesting.
Okay, so there is the economic policy uncertainty index, which is done globally. Okay. So this easily available on the website.
Oh, so it's low for us and high for others, is it?
It is low for us, okay. And it is very high for others. Okay. And that's telling. I mean,
all right. I wanted to toss that to Mr. Shankar Raman, actually, who should feel the brunt of uncertainty if it were. Mr. Shankar Raman, the nuanced question I want to ask you is, when you look at these orders and tenders floating around, is it a hope of Capex, or is the Capex already there? And are you seeing any of the uncertainty that Mridul is referring to? Are people checking back, or are they ordering and then waiting, for things to start off?
It's in different buckets. As far as the government programs are concerned, where they're already midstream,
Yeah.
I think they're going ahead and completing the program. And there is also a political milestone that is around the corner with 24 elections.
Yes.
I think it's important that these projects which are announced have been completed. So to that extent, the government capex is moving ahead based on the commissioned state of projects. As was mentioned, I think the fresh awards are getting a little slower because the rate of interest is moving up. The debt markets are reacting. Consequently, the sponsors are willing to wait and watch as to where they're going to pitch their project returns. So to some extent, we can understand a bit of a slowdown. And also the commodity cycle seems to be turning. Much of the commodities are maybe at 80% or less of the peak that they were trading in about beginning of this calendar year. So that is also changing the economics. So from one perspective, I think the government programs moves forward. Private sector, some of those where there is pent up capacity creation, which has been held back in the last few years, are going forward, because I think there is optimism that India will survive this crisis and move ahead. But insofar as uncertainties are concerned, obviously, I think we should guard against policy errors because I think it's very important to be very careful in good times.
Oh, yes.
Bad times, everybody is careful.
Yes.
So policy errors is something that we should avoid. Secondly, I think the general thrust towards improved productivity is something that the industry, particularly the private sector industry, is focusing on, because skills are getting scarce and the automation is sweeping the world. So it's a double whammy in terms of relearning, unlearning and relearning at one set, and the other set would be to keep pace with the growth in technology. So consequently, I think the capex for private sector, I would like to believe that they have returned, not with full gusto, with full gusto. I think people have burned their hands black and blue once before. So they will wait and watch. It will happen sectorially, but incrementally. I would expect over the next 5 years, the capex to come to its full clip.
Oh, that's a very optimistic note for me to take a break. But some more skeptical questions after the break in terms of the global uncertainty that's looming, as well as whether demand is good at the bottom of the pyramid. Ultimately, capital expansion will depend on that, on job creation and demand. Those questions after the break. Welcome back. I have been speaking with Mr. Mahesh Vyas, the Managing Director and CEO of CMI, with the former Monetary Policy Committee member Mridul Sagar, now Professor at NCAER, and R. Shankar Raman, Director and CFO at Larsen Toubro. We've been discussing whether the Capex cycle has well and truly started. They all agree that it appears to have started, but its continuation is what we are going to discuss now. Mahesh Vyas, on that issue, you have seen previous cycles. What is the sense you are getting? Several projects also fall off. So given your experience of previous cycles, are we at the start of the cycle? Are we well into it? Or would you still think that this could be stillborn?
We are still early into the cycle. I will not say that we haven't begun, but there are some things that have begun which usually begin when Capex begins. So state governments have become very active in trying to attract investments. And that has led to a large extent an increase in the investment proposals from the private sector. So the state government's substantial activity in trying to attract investments to them is, mind you, much higher than what we have seen in the past 2 years or even 3 years. So that's a big pickup. But the completion of projects is still quite slow. So we had expected in the fiscal year 22-23 for completions to really take off, because 2 years of pandemic and all the associated uncertainties had led to these projects being withheld from completion. And so in 22-23, from an average of around 6 trillion rupees worth of completions that we have seen in the past, we had expected 10 trillion. But last month or a couple of months ago, we scaled that back to 7 trillion. And now, even that 7 trillion looks a little dicey. We may have to roll it down to 6.5 trillion, which is close to where we were before the pandemic. So no big gain after having almost lost 2 years of completions. So that's a bit of a dampener. Also, what was a little bit of a matter of concern was what we noticed in the RBI's Obicus survey, which in March 22 had said that the capacity utilization was 75%. In June, that's down to 72%. So although there are some order book positions which are increasing, there isn't enough of evidence to say that we are rolling. We are probably just beginning, and it is good to nurture this and to see that it catches momentum.
Okay. Well, actually, RBI corrected by saying that seasonally adjusted, that June number becomes a little higher at 74.3. So I don't know about that number, but I take your point. And the bigger point you're making is about this completion of projects, which certainly is a bit of a worry. Mridul Sagar, what about the other worries? Can global uncertainties, I mean, we are talking about near recessionary conditions in 3 of the largest economies, in the euro area in particular, China as well, slowdown, not recession, and US probably impending recession. Can these take away the sparkle from our growth?
Yes, they can. I already pointed out to the Kellogg School economic policy uncertainty numbers. But I think we have to wait and watch. If global slowdown deepens, then effect will come. Nothing is certain about the war. So it will all depend on how global supply chains get affected. And that's sort of also reflected in the dichotomy, the credit growth, which we were citing as very high.
Yeah.
Part of it is inflation effects, and part of it is elongation of the working capital cycle because supply chains are affected. So not all is Capex. The Capex also is improving. You already clarified that the Obicus number is not a worry.
I take your point. Mridul, the other question, the other doubt that keeps coming to the mind is, the bottom of the pyramid. Even now, FMCG companies tell us that their volumes are growing in low single digits. They are bemoaning the lack of demand from rural India. Ultimately, if the consumer is not growing in numbers and in purchasing power, can the Capex cycle be stillborn?
So you're absolutely right. The accelerator theory of investment tells us that it's the lagged sales or the lagged output which actually drives most of the investment. And so there is this issue. If the consumption drops, then Capex cycle could get terminated. But I'm not too worried about consumption dropping in India. I really don't see that happening in a big way. I'm more concerned about structural issues which still plague us, and let us not soft pedal them. This year, the NHI, for instance, the tendering has been very low compared to the target. They may have covered just some 10% of what the target is. And so far in the half. Also, execution has been little lagging. In terms of spending, yes, the spending on Capex has been good from NHI also. They seem to have almost covered what they spent last year in just one half, but it's not translating on the ground. So we need to sort of look at it deeper over what's the causal factors here. Also on the asset monetization proceeds. So asset monetization is working fine in some segments, but is not working at all in some segments. For instance, the NHI has been able to do the asset monetization and roll the investments out. The railways haven't been able to do that. Neither is the oil and gas been able to do that. So clearly, oil and gas don't have worthwhile projects, so they have no incentive to do that. Yeah. So whereas railways, I don't know why the plan is not really working. I think they need a more framework of concession agreements and stuff. So I think the structural issues still need to be focused on if we really want investment to pick up on a durable basis.
Okay.
We are at the right point now, but the government has to take further steps to ensure that this is done.
Fair point. Well, the government has its PLI scheme, hoping to tap those who are perhaps leaving China or not wanting to do incremental investment in that country. That question to you, Mr. Shankaraman, are you seeing that PLI or China Plus One scheme working? In your October 31 presentation post results, you did point out that the Middle East demand has gone up, infrastructure, hydrocarbon-related projects. But are you seeing other regions of the world come in, especially the China Plus One?
The incremental investments have been pretty modest because in the context of PLI scheme, there are about 14 sectors which the government had highlighted for that $34-35 billion worth of allocation. But these are largely in small, medium enterprises. Okay. As Larsen and Toubro, we don't get to participate in those build-outs, which are for our context subscale. But the fact is, on the ground, a lot of investments are happening at the small and medium level enterprises. I think they are waiting for the ecosystem to also settle down, because logistics is a big issue in India. Today, the markets and the raw materials are quite divorced, and they're not serviced by efficient supply chain. The ULIP program, the United Logistics Interface program that the government is talking about, needs to come to party. I think it's very important that the steps that were to make the logistics simpler, turnaround time faster, and cheaper, more consistent, reliable, all that has to come into play if manufacturing has to pick up. Insofar as Middle East is concerned, I think it is a bit of an opportunity that played out to their advantage because of the energy prices.
Yes.
And also the fact that a large market like Saudi Arabia is beginning to talk about not only exporting energy, sources of energy, but also using the energy to develop products and processes which they can export to the world. So I think their ambition is becoming larger, which is actually helping us as a company to participate. But at the moment, since we're talking about India, my own belief is that if India were to move to this 7.5 trillion economy, I think investment in core infrastructure, even given the fact that we are hampered by slow clearances, still issues like land approvals, utility clearances do take time. They are not as fast as it is intended to be. But even given those, I think India needs to continue and sustain its investment in core infrastructure, port, airport, roads, etc. We are now used to the fact that some agencies work at good speed at some points in time and some agencies slow down. I think Mridul was pointing out to NHI actually slowing down this year. They're also hampered by a very slow-paced dispute resolution. I think it's one thing to put out contracts. The other thing is these contracts often create disputes. And these disputes have to be very commercially and prudently resolved. You cannot keep going to arbitration and go to courts and stuff like that and lose valuable time. One of the biggest problems for delayed execution is our ability to take commercial calls given the structure of a contract.
Fair point.
Unfortunately, government isn't enabled to do this.
Well, all those points are well taken. Dispute resolution has to improve. But all three of you leave me with a very optimistic feeling that the Capex cycle has started. Now we have to see how long and how high it goes. Thank you very much for joining me in this edition of Indianomics.